I want to have a quick chat about property tax. More just the technicalities of how your property is taxed, because if I really get into it, I'm going to go on a whole tangent about why property taxes are bad on private residences. But it became apparent to me that how properties are taxed and how they're assessed is a matter of confusion when I was watching a video from a smaller creator here. And I appreciated some of the points made in the video about affordable housing and property values. And in the comments, somebody said that they were a homeowner and they actually wished property values would come down because then they would be taxed less on their property. I commented back and informed them that if all the properties in an area all came down together because we did something to make housing cheaper as a whole, what you actually pay in property taxes would remain unchanged regardless of the value of your property. See, because despite common popular belief, you don't pay taxes based on what your property is valued at. You pay property taxes based on your portion that you owe of the jurisdictional budget in which your property resides. And how much you owe for that total budget is decided based on the value of your property. And then when I said that, the creator jumped in the comments and he's like, that's not how taxes are assessed. And I'm like, I assure you, my guy, it is. That's why an increase in your property's value doesn't automatically mean an increase in your taxes, or vice versa. And he's like, try looking up any record of where property is taxed like that. And I sent him multiple records because that's how they're taxed. And guess what? I own 2 properties and they're both taxed that way. Now, to be fair, every jurisdiction taxes differently. So this probably won't be 100% accurate for every situation or every type of property. But this is the general rule of thumb. And when I provided him with those examples, he's like, Google tax formula and see what you come up with. Because despite me finding any records and providing them to him, that wasn't enough. And he needed me to Google the thing that he thought justified his perception. And he still very confidently doesn't get it. And I know that this is a really confusing topic, so I decided to make a video to educate all of us on how property taxes work. So your property tax rate is called a mill rate. A mill is $1 for every $1,000 that your house is worth. If you have a $100,000 house being taxed at a mill rate of 5, your property taxes would be $500. So at face value, it seems like they'd be taxing you then on the value of your property. But it's not, because the mill rate changes usually every year. So unlike income or sales tax, where you're paying a set percentage no matter how much you buy or how much you make, one year you could have a mill rate of 2, and the next year you could have a mill rate of 7. How they set the mill rate is they figure out the value of all the property within their jurisdiction. And then they figure out how much revenue they need to pay all of the bills in the upcoming budget. And they set the mill rate to hopefully make those 2 numbers match. So your property can go up in value and your taxes could go down, or your property could go down in value and your taxes could go up. Your property could stay exactly the same and your rates could go up or down. Perfect example of this is one year my property's value increased by like 20%, according to the tax man at least. This was also the same year that Polaris, a major company that operates in the same county, had its 10-year tax-free carrot to build there expire. So they went from paying $0 in property taxes to being the biggest taxpayer in the county overnight. But the county budget didn't change all that much. So the portion of the county budget that I personally owed went down because Polaris was picking up more of the tab, despite my property value going up. But this is the same reason that if we passed legislation that made property values more affordable and therefore brought down property values across an entire jurisdiction, you'd be paying the exact same dollar amount of taxes just at a higher mill rate on a lower valued property. Now, if just your property value or the property values of a hyper-localized area in a larger jurisdiction decrease, then your mill rate would probably stay the same and you'd likely be taxed less because of that decreased value. But if every property in the jurisdiction drops roughly the same percentage in value, well, then your property taxes probably aren't going to change much because the county's still going to have all of the same bills to pay. If you've ever been curious about how they figure out your property taxes, that's probably how they do it where you live. And if you ever decide to tell me to prove something by showing you a record of it and then I show you that record, maybe you should take that as a cue to stop being so confidently wrong. Just a thought.